Hey everyone, this is Gary. Hope you all are well. Welcome to this week's webinar. I apologize for the change in dates. I think that was last week. Beverly sent that out. It was my own doing. I looked at there was a class that was scheduled this week that was not scheduled at the time we put out the webinar schedule for October. For end of September. In any case, the travel time tomorrow night, there was no way I could have made it in time to do the webinar. So we realized that we changed it. So please forgive us for making a change. I guess it was within probably a week before the actual webinar date. But in any case, enough said about that. Welcome aboard, guys. In particular, welcome to all the newer folks, all the veterans. I've seen people on here literally from 2 years ago. So glad to see you guys. And I can't wait to see you again, by the way. So Maxine, I will be coming back down to Arkansas. I don't know the exact schedule yet. And Cedric, definitely California this coming winter, probably January all the way through mid-April. And actually, what I might do is swing down through Arkansas and then go across Texas, Arizona that way. That's what I did the last time, and just teach classes along the way. So in any case, I look forward to seeing you guys again. For all the new folks, a lot of New Yorkers on here, a lot of folks from New Jersey. Again, we do have the next 3-day event coming up this weekend. 28th, 29th, and 30th. 28th and 29th are both 9 to 5, and 30th is till 1 o'clock, which is Sunday, at the Westchester Marriott. It's in Terrytown. I think 670. Hang on, I guess I should know this. 670 White Plains Road, Terrytown. I think we're at 60. However, if you want to try to squeeze in, guys, if you're an active student, you don't have to pay to go if you're an active student. But I know Beverly's been able to make accommodations for people in the past. I think, in other words, what I'm getting is the head count 60, and that was the cap. But I think if you want to go, obviously, just let Beverly know, and I'll go to bat for you. But in any case, the next one is the last one of the year. So if you have not been to one of these yet, the 6th and final one this year is in Chicago, November 2nd, 3rd, and 4th. We got a few surprises there. One of my colleagues is a tremendous investor in Chicago. He runs his own RIA group. They got like 6,000 people in it, and he buys big multi-units all the time. Actually has his own plane right now, and I've known him for years. And I tell you, he did verbally commit to come speak to you guys at the event. So keep an eye out for that. We'll probably post that within a week or so, I'm guessing. But in any case, for all the new folks, a little bit of housekeeping, guys. You'll notice that by default you're in mute mode, and that's on purpose because we can't all be speaking at the same time. You can use the question box to type in your questions, which is what we normally do. From time to time, I will unmute you, okay? And we can have a live conversation depending on the subject. So speaking of live, we are live, we're recording. So let me type in my usual weekly message, which is, can you see me and hear my voice, if I can spell voice. I just want to make sure everybody's okay on video and sound. So if you could get back to me on your question box, let me know that. Hey Genevieve, good to see you. Hey, we got some Canadians on board. Excellent. We got a couple of M1 groups on, M1 guys on here. So for those of you who don't know, M1 is an acronym for March to a Million. It's people trying to get to the first $1 million. Genevieve's asking, coming to Montreal soon. I sent you an email about 2.5 weeks ago. Not sure or recall. You know what, Genevieve? I don't remember seeing that. Send it to me again. Send it to Gary at myinvestmentservices.com. And I think you might have my phone number. If you don't, let me know, and I'll be glad to give it to you. I'm not sure when I'll be in Montreal again. It's probably going to be in the summer, this coming summer, actually. So be good to see you and see all the other folks out there too. So in any case, let me do this, guys. I need to figure out what I just did here to the screen. Okay, I'm okay. So I just want to make sure we go through the questions. Or before I get to the content, I'm gonna look for questions, guys. Some of you have posted questions. This is Stephen. Hey, Stephen. It's the KW Landmark 2 team in Queens. Okay, good to see you guys, man. All right. There's Genevieve's question. coming to Montreal. Daryl, hey Daryl, glad to talk to you earlier. Let's see, Rolando, hey Rolando. I thought I saw another clear. There's Debbie. Yes, can hear you in Las Vegas. Oh, hey Debbie, good to see you. I know you're pretty new. Let's see, Genevieve. Okay, Genevieve, I'll you know what? Do me a favor. So email me at Gary@myinvestorservices.com, Genevieve, and we'll go from there, because I want to be able to help you out whether I'm there or not. So, in any case, guys, I think I'm all caught up on everything. So let's go ahead and jump into tonight's subject. So real quick, by the way, even whether you're new or veteran, always make sure you look for the email the next day from Beverly. It's going to contain the recording of tonight's webinar. It's also going to give you any updates to the systems, the platforms, update to the content, the upcoming webinar schedule, and things like that. Just stuff you need to know to stay on top of things and stay on board. Let's go ahead. So let's go ahead and jump into this. I think I'm caught up on all the admin stuff. Okay, so every now and then I get requests from people to help them look at properties to analyze them. We're going to do that again tonight. We got two of them. I'm going to try to do two of them tonight. One's from Dan Levy in Virginia Beach, and the other one is from Fassel up in northern New Jersey. So Dan's came in first, so we're going to do Dan's first, and then we'll do Fassel's. Okay. Now, what I want you guys to do is really pay attention to this tonight, because we're going to use two different calculators. We just did this, I think, last month for, who was that? Was that Kate Crowell? Maybe that was 2 months ago. So definitely pay attention, because you're going to learn how to use these more advanced calculators. They're actually not that complex, guys. All of the math is done for you. You just have to type in the variables, which are your rents and your expenses, okay? So let's take a look at what I told Dan was, I looked at these things already. There's actually another sheet of properties that Dan gave me. The reason I picked this one is it has 4 multi-unit properties on there. 3 are in Norfolk. See Norfolk right here. There's a 12-unit, a 27-unit, and a 14-unit. And then in Hampton, which is across the Hampton Bay Bridge Tunnel, is an 8 apartment building. So when I looked at all these, to me, it looked like the 8-unit was the best deal. So let's take a look at the 8-unit. And there's some notes down here I'll show you in a second about different expenses and things like that. So we're going to take this property. I'm going to reduce my panel, so I'm not going to be able to see you guys for a moment, okay? But I want to have this in full view. So what I thought we'd do is let's take the 8-unit building. They're looking for $400,000 on that property, okay? So the first thing we're going to do is use what we call the rental property calculator, okay? Which is this tool right here. So I'm going to use this first for Dan's property. By the way, real quick, let me just go back here 1 second. I'm sorry, guys. Let me show you where you can find these, all right? So if you log into myinvestmentservices.com, okay? So you go there first, then you click on the events. I'm sorry, you click on members area. Click on members area right here. I'll click on that. Okay. And then down here where it says members, click to log in the silver level. By default, every one of us is a silver level by default. Even if you're at the coaching level, which is the gold level, and then the platinum level, which is mastermind level, all of you have silver level. There's nobody on here that's bronze level because they're not allowed. Okay. That's just you guys. So you click on silver level. All right. There, by the way, there's a login page for silver that didn't show up because mine takes me there automatically because I log in all the time. You'll have another login where you've got to enter in your login and password. Then it takes you to this screen right here, silver level membership. Okay, it looks like a inside of a library, which is near and dear to my heart because I love to read, and I still go to libraries. I don't care how advanced we get technologically. There's stuff in libraries, guys, you can't get online. Okay. And if you're in a bigger city, you actually have more access to more libraries and a lot more. And they actually communicate with each other and they send books back and forth between the library systems, which is really neat. So I can be up in Toronto and want to get a book, and if I see it on the system, it may be in Washington, D.C., but they can communicate back and forth, okay, and ship those books back and forth. So in any case, I want to show you this. Over here on the left-hand side is your panel that gives you all the things you can do. Newsletter, blogs, cash buyers report, private lenders report, all the recorded webinars, celebrity interviews, premier ebooks, which you guys all get for free. They're free books that everybody gets. Marketing docs and techniques. So I want to, and then down below that is analysis forms, calculators, and things like that. So I want to click on that. Okay. And down here, you will see the different calculators. Okay. Cash flow analysis, which is a basic, real simple cash flow formula. You can learn it in 60 seconds and teach it in 90 seconds. Okay. Inspection reports, analysis reports. Rental profit calculator. That's what I'm showing you now. And then this one here, which is rental property investment calculator, which is an online real-time version. Okay, so let's do the first one first. Let's do rental profit calculator, which I've already got up. Okay, and we're going to start plugging in some of Dan's figures. Let's go back to Dan's spreadsheet. So we got $4,700 in rents coming in on a monthly basis. They're asking $400,000, and we've already got some utilities of $524. So let's just start with that: $400,000, $4,700 a month, and $524 on expenses. Let's go back here. Okay, I'm not going to fill in all this over here, guys. This yellow box is where you fill in all of the details of the property, address, square footage, things like that. Okay. For purchase price, we're gonna, let's just say it's $400,000. Now he's not gonna pay $400,000, obviously. It's just what the seller is asking for it. Okay, let's assume we're gonna put down 20%, $80,000. So we're gonna have a loan then of $320,000. Okay, and let's assume we're gonna do a loan term of 20 years. Amortization period of 20 years. And by the way, remember this, you can have an amortization of 30 years, but a loan term of something shorter, like 20, 15, 10. So what happens is, at the end of the loan term, let's say this was 10 years, okay, and you're amortizing for 20, that means at the end of 10 years, you still got a principal balance on the loan, and you got to make what's called a balloon payment, or just, basically you refinance or reprice it. But for this exercise tonight, we're going to make sure the term and the amortization match. Okay, interest rate, let's just call it 5%. Payments per year, obviously that should be 12. Okay, and you can see now it calculates the monthly payment is $2,111.86. And we also need to make an initial investment of $80,000. So that when I plugged in this loan information, it automatically calculated not just the monthly payment, but also the down payment requirement. Okay. So far we got that part squared away. Everybody okay so far? If you could just type in on a question box, say, yep, Gary, I'm okay. If you have questions, let me know. I'm going to go ahead and plug in the income, and then I'll take a quick breather and look for your guys' questions if you have any. So we said the property's bringing in $4,700 a month. And normally what we would do, if we look back at Dan's spreadsheet, we don't have the details on the individual units. Actually, we do. We know that they're 1 bathroom, 1 bedroom units, and he's bringing in $4,700 a month on 8 units. So let's go back to the calculator. Let's just, for the sake of simplicity, let's say there's 8 of these units. Now the thing is, we're bringing in $4,700 a month, which means if it was $4,800 a month, it would be $600 per rent per month for annual gross receipts of $57,600. But we know we're bringing in $4,700. Let's just do this. Let's change this to 1 unit. Okay, 1 unit, and make this $4,700. And see what the annual comes, $56,400. The only reason I did that is, guys, I don't have any more details. I know the gross monthly receipts is $4,700. That's why I plugged that in. If I had the details on all their individual leases, I would have plugged in 8 here under number of units and put in the monthly rent for each unit. But because it's an odd number, 4,700 instead of 4,800, I'm assuming he's getting 600 a month per unit, and one unit is probably getting 500. I'm just making a guess there. Okay, but regardless, we got 56,000 a year, 400 coming in for gross receipts so far. Not a bad deal, right? Now let me bring up the expense section, but before I type anything in, let me go to the question box and see if you guys are okay. Let's see, it looks like you guys are okay so far, so good. Okay. Hey, Fastball, I don't know if you were on, but when I first started with Fastball, I'm going to bring up your property next, okay? So let's go back to the calculator. I don't see any current questions here so far. Oops, here's the calculator. Now we got to figure out some expenses. One of those expenses, actually, well, we're not yet. One of the things we have to account for is vacancy. Right now, guys, vacancy is at an all-time high, which means, I'm sorry, all-time low. Vacancy is at an all-time low. Occupancy is an all-time high. So let's just say on a percentage basis, there's only 2% vacancy. Okay. Well, you can see it does the calculation for it. Automatically comes out to $1,128 a year lost income because we got a 2% of the time we have a vacancy. Now, what that means is if you take all the 8 units, multiply them times 12, okay, you've got, that would be 96 rentable months. Out of the 96 rentable months, 2% of that time the property, something was vacant. That's essentially what that means is, let's just call it, 100 rentable months. That means you've got 2 months where a unit was not rented, okay? And I will tell you guys, vacancy is the killer of profits. The reason is if a property is vacant, no income is coming in on that unit, okay? And the expenses are still going out. So vacancies are your worst enemy. You do not want to have vacancies, and there's ways you can overcome that. I'll discuss it on a different subject, different night. Ways to decrease vacancy. I'll give you a big hint. One of them is this. Obviously, you want to have decent properties with decent tenants, and in your lease, you should have in there that at the end of within the 30-day period of the ending of a lease term, the owner or landlord, property manager, excuse me, have the option to show that vacancy at any time during the last 30 days. You have to work with the tenant to get access rights. You have to notify them within 48 hours when you're coming over. And it has to be during reasonable hours. You can't show a property at midnight, for example. Anyway, so it's one of the things you can do to eliminate or reduce vacant time. Is don't wait till somebody moves out to fix it up and lease it out. Show it and get it leased so the new tenant can move in within a few days after the last tenant moving out. That's how you got to be aggressive, but that's how you do it, guys. Okay, so we talked about vacancy. Other income not affected by vacancy. And I think Dan had some laundry income coming in. Actually, he doesn't have any laundry on this property. And I will tell you what, guys, if that was my property and I had 8 units, I'd have some laundry income coming in. I put laundry anytime I have 5 and above, right? 5 units and above. So let's just say we got some laundry income, because remember, this is a basic pro forma working out here. Actually, let's leave it blanked out. Let's assume the laundry is coming in. I'll come back later and we'll adjust this and see how we can improve the performance of the building. So real estate taxes, I don't think, let's just go and see if we have that. I don't think we do. He doesn't put taxes on here. Hang on one second. I could be wrong, but let me go down here and see what the notes say. Okay, 11 units, it's 675, 1 unit, 550. Okay, that's one of the notes. That's another note, that's another note. Last year's average utilities. Okay, so that's all on the upper 3 properties. So we don't have anything more on this property. That's okay. We're going to plug in our own values, okay? So we know we're going to have taxes to pay on that property, obviously. And on a building like that, I'm going to bet you're paying $8,000 a year in taxes, property taxes, okay? No property, personal property taxes, property insurance. 8-unit building like that, I'm gonna say $1,200 for the year. Okay. Let's see, management, let's call that, if we call it 10%, that's going to be 5,600, let's just call it 10%. So $5,640 in property management. Payroll, we're not going to have any payroll, okay, because we have a property manager. By the way, guys, really important thing here to remember. Whenever you or your clients are buying a rental property, even if they want to self-manage, always account for property management. And the reason is if it's self-managed, is that person not deserve to be paid for managing the property? That's not the same as getting profit as an owner. Profit as an owner is different than earning money as a property manager, a fee income. So if you're going to self-manage, don't just determine your return as far as profit goes, determine your return if you're going to self-manage as far as property management. You pay yourself. The other reason is this is, you may decide to turn it over at some point in the future to our property manager. And if you did not account for that in your initial pro forma when you bought it, you got to make up for it somewhere else. A lot easier to do at the beginning than it is later on. Okay, so let's go back here. Maintenance and repairs, labor, materials. Let's say we got 8 units, $50 a month. That's $400 a month, $4,800 for the year. Maintenance and repairs. Okay, I'm just using a rough figure of $50 per unit per month. Okay, that'll cover a lot. I mean, you're not going to spend $50 a month per unit every single month, but so much, you might go a year without spending a dime, and then all of a sudden you need a water tank, for example, $800. There you go. Okay, utilities, we're not paying anybody's phone bill. In our rentals, I don't pay anybody's gas or electric. Okay, I do pay water and sewage. Let's just combine, let's say water and sewage combined. Let's see, what's that going to be? 600, let's call that 4,800 also. Okay. Now, accounting, legal, licensing, advertising. You might spend, $80 on advertising vacancies. Supplies, lawn care. Let's just combine. Let's see, garbage might be 600. Let's just combine lawn care, landscaping, snow removal all in one figure. And let's say we're spending $50 a month on that. Oops, so that's going to be $600, okay, for the year. You can see you're spending $25,000 on expenses on the property on an 8-unit building. See how that stuff adds up, right? This is why we like this calculator. Okay, so right away, we've got our net operating income, which is our total gross receipts up here minus vacancy. So what that figure is 55,272 minus expenses of 25,720 gives us a net operating income of $29,552. When you subtract your debt service, remember the annual payment on our mortgage is $25,342. Remember up here. We add up all the monthly figures here. 2111.86 times 12 gives you $25,342. So at the end of the year, you got $4,200 in positive cash flow. Not a bad day's work, all right? Debt coverage ratio and cap rate. Cap rate for that area part of the country, I'm pretty familiar with that part of the country. I think we can improve it a little bit, and we definitely need to improve the debt coverage ratio. We got to get that to 1.2 at a minimum, okay? By the way, according to this, if your cap rate is 10% and you sold it after a holding period of 5 years, you wouldn't want to sell it. You wouldn't want to sell it for anything less than $295. You would never do that, obviously, but you'd have a cash out, a loss at $24,000. So let's do this, guys. Let's have some fun. Let's say we raise that one guy's rent by $100, and we bring in $4,800 a month in gross receipts. That improves our bottom line by $1,200. And let's say we also have laundry income coming in at 8 units, say $10 a month per unit. That's $80 a month times 12 is $960. Whoops, where'd I go? There we go, $960. Okay, let me go back here. We're gonna change this because I just messed it up. 4,800, and all of a sudden, we should have a slightly improved bottom line. Let's see, let's do, I don't know if it did the calculation. I think it went up by a few $100. Let's see, what we got. Other income, 960. We raised the rents a wee bit. So we just added about $2,000 to our bottom line. I'm not sure what happened down here, but we should have a lot bigger figure. But in any case, actually you can see the debt coverage did go up a wee bit, 1.175. So let's do this. I think 600 is a little bit low per unit per month. So let's say it's, let's raise it by 10%. So let's just do this and another $480. That's going to be $52.80. Okay, that improves the bottom line a good bit there. Now let's see what we have here. There we go. Cap rate 8.9%. That's definitely within striking range. Debt coverage ratio well above the 1.2. $10,000 a year cash flow. But now let's do this. Here's the challenge. Would you put down $80,000 to get $10,000 back on the annual basis? Well, I probably would want to get a better return than that. So let's do this. Let's say we're not going to pay $400,000. We're going to pay $360,000. Okay, and we're going to say our mortgage is now, let's see, what is that? 360. So that's going to be 80% of that. 240,000 plus another 288. I think that's what that comes out to. So 288,000. I think that's right. Yeah, 360. So 300. 20% is going to be 60,000, and then 80% of 60 is going to be 48. So that's actually so 48,000, and what did I say? 80%. That's 240, 288. Yep, that's right. Okay, so our mortgage payment goes down. All right. Now let's see what happens to our bottom line. So initial investment 72,000, not 80,000. We still have pretty good rents. Everything else remains the same. And voila, we've got it to 9.8. That's about as close to 10% as you can possibly get. Okay. And now if you look at the value on a sale, you would sell it for $354,000, you know, to basically cash out at $66,000. So in any case, I would probably pursue this property, Dan. That's my opinion based on the area. Based on these numbers, you're within striking range, 10% off the sale price or what the listing price is. And we've actually added some figures here, Dan. And we added in, you know, taxes, property management, insurance, all kinds of stuff. So that should be pretty close to the mark there. What I want to do, guys, is this. I want to bring up what we call the rental property calculator, which is this. Okay. So let's go here, and that should take us, and here we go. This is my, let me close this out. One of my favorite ones. So let's do this. We're gonna go through this because we gotta get the fastest property too. All right, current value. Let's call it, what do we say, $360,000, right? We're gonna make a cash investment of 72,000. Oops, wait a second. Percentage basis, 72,000, mortgage 288, mortgage rate, we said 5%. We're going to look at assumptions. We're going to say the loan term is 240 months. If you notice, guys, I didn't make it 30 years. I didn't make it 15 years. I made it 20 years. Good reason for that, just beyond the scope of tonight's lesson. But just remember this, 20 years is a great term to get on rental properties, okay? Always ask for it, even if if a bank doesn't advertise it. Always ask for it, okay? How do we get out of this? There we go. Okay, so long term purchase cost, let's just keep that at 1%, okay? Percentage of sales, this is you as the buyer. All right, monthly rents, we said, what did we say that was? 4,800 plus another 480, that's 5,280. $52.80 per month. Okay, we're going to leave cap rate alone for the moment. It's going to change. Okay, we're going to assume a vacancy rate of 2%. Remember that. Our rent increases, let's make that 3% on the annual basis. Property improvements, leave that at 0, assuming it's turnkey. Okay, let's look at other assumptions. Property management, we said keep that at 10%. Maintenance, let's see, 1%. $50 is $400, is $4,800 for the year. Let's keep that at 1%. Insurance costs, let's keep that at 0.05. Move in, move out costs, I don't think it's going to be that much. Let's say it's $1,000 per move out. That's somebody moves out, somebody else moves in. Hang on one second, guys. Allergies are kicking in. Excuse me. No way to stop that on a live broadcast. In any case, sales price. So this is if you sold the property in 5 years, what you would want to sell it for. So we're going to assume selling costs, percentage of gross sales. Let's keep it 6%. Appreciation rate, let's say it's 4% per year. That's actually pretty accurate for today's market. Okay, value of land, we're going to say is about, let's call that 5%. Okay, property tax rate, we're going to make that a percentage of property value. Let's see, if I said 1%, that's going to be 4,000. We're going to make it more than that. Let's make it, if we made it 3%, that would be 3,000 times 3, 9,000. Let's call it 3%. Okay. Let's look at other assumptions. Your tax rate, let's make that, well, let's keep it 25%. Capital gains, let's keep that at 15. Expected inflation, that's pretty low right now, but let's just say 2% is reasonable. Investment hurdle rate, guys, what this is you're plugging in a value that in theory represents a potential return on any other non-investment related real estate, non-real estate related investment, excuse me, like stocks, bonds, mutual funds, like things like that. So you can get that, you can look and see what's been the average annual return over history of the stock market. It's probably going to be somewhere around 8 or 10%. So you can plug that in. It's already plugged at 8%, so let's keep it there. In other words, we want to beat that 8%. That's our hurdle. That's what they call it, the hurdle rate. We want to beat that hurdle, okay? Now, if you look at some of the results here, your return on cash invested over the 5-year holding period will be 202%. In other words, you take your 72,000 and it increases by 200% over a 5-year period. Not a bad deal. 5-year projected internal rate of return, 30%, looking pretty good. So Dan, if you're watching, this thing is looking even better. Right now, what we want to do is show other tables. By the way, projected cash flow. Initially, the day of purchase, you plug down 72,000, so that's your cash flow minus 72,000. Year 1, your projected cash flow is 10,780. Year 2, you should make 14,000. Year 3, 15. Year 4, 16. Year 5. You add everything up, including the cash from a sale, comes up to 160,000 cash flow. Net, if you net it all this together, you've got a net return of 145,000. Not a bad deal. Put in 72,000, gets 145,000 monthly cash flow plus the sale proceeds from a sale. That's what that means. Okay, now let's see some details here. All right, there's other things we can look at. Oops, let me go back here and bring some of these up. Table run, cash flows, and return on investment. So initially you plunk down 72,000, right? We already talked about the cash flows each year. By the way, the 5th year cash flow without the sale is 17 grand. That's net operating income coming in your pocket from the rents minus expenses. A sale price, 4% appreciation rate over 5 years. You'd sell it for $437,995. Your selling cost is 6%, we said, which is 26 grand. Taxable gain is 113,000. In other words, the cost, your sale minus the cost basis leaves you a taxable gain of 113,000. Okay, you're going to pay 27,000 in taxes. If you're in a 25% tax rate, you're going to pay 27 grand on 113. All right, so you know, and you got to pay off the mortgage. By the way, there's still 241,000 left on the mortgage you got to pay off. Remember, we started at 288. we paid it down to 241. This is over a 5-year period. That's the parameters on this calculator, okay? In any case, your total returns, obviously first year you put in 72,000, so that's a, that's an expense, or actually it's cost basis. But the reality is it's a net minus 72,000 because you put it in there. And then each year you add up your total gross receipts plus plus your proceeds from the sale added onto that 17,000 in year 5, and there's your net, 145,537. Now we're not done yet. If you look at your return, your ROI, factoring everything in, depreciation, appreciation, net operating income, here's your rates: 15%, 20, 21, 22, and 24. Total of 103% return. All right, your present value cash flow is discounted by the hurdle rates. In other words, if you took the cash flow you had coming in and you discounted it by the hurdle rate of 8%, you basically cleared 77 grand. You made 77,677 over and above your 8% hurdle rate. Okay. For those of you who are new, by the way, and you're watching this, and this feels like it's over your head, don't worry. It's just because it's the first time you've seen it. This calculator is actually all done for you. You just got to plug in your numbers, and there are instructions and helps to go with it, so you can learn and read and study what some of these ratios mean. For right now, though, just know this: if you're an agent working with investors, this is one of the coolest tools you can ever give one of your investors. Okay. So when it gets back to that sales price, we said we'd sell it for $437,995. We got to pay $26,000 and 6% costs. So your cash proceeds are $411,000. Now, your depreciated basis, what that is, guys, is, remember, we paid $360 for it, but we depreciated the property every year. Essentially, it's 3.41%. All it is a phantom write-off. It's what Uncle Sam gives you for the privilege of owning the property, and a tax write-off. Okay, so it's a paper write-off. In any case, that knocks down your cost basis. That 360, if you kept knocking off 3.441% for a year for 5 years, your cost basis is now 297. That's what you're going to end up being used when you calculate your tax that you're going to pay on your gain. So if you sold it for 437 and you depreciated it down to 297, you're going to have to pay taxes on about $140,000 in gains. Okay, so taxable gain, well, on the surface is 113,000. Then you got to recapture the depreciation you took over the 5 years, which is 15,000, and the capital gains taxes, and you got to pay 15% there. That's 11,000. See how Uncle Sam's starting to cut into your profit here? Well, you're going to pay off the note, right? 240,000. At the end of the day, the cash from the sale minus your taxes and paying off the mortgage is 143,000 essentially. Not a bad day's work, guys. That's essentially you took 72 and doubled it to 142. That's a pretty good payday in 5 years. In other words, if you can double your money in 5 years, that is a good day's work. Okay. Okay, so that's that table. You can see there's 3 more tables. Let's just get through these real quick here. Financial projections. So you're going to look at all the details here. You got your rents coming in, 62,000, going up 4% per year, and your total. Then you add up all your interest you're paying on the mortgage, your taxes, your insurance, the turnover costs. Remember, whenever somebody moves out, you got to pay for it to get cleaned and painted. Maintenance and repairs, your buying costs, remember we said was 1%. Property management, we said was 10%. Okay. So your total rental income, total rental expenses is 40,000 for the year, going across the board, 37,000 after the first year, excuse me. So total expenses here, 188. And net income, there you go. There's your net income on an annual basis, 1, 2, 3, 4, 5, and the total of all 5 years added up. Now you got to take back, remember depreciation, we talked about that. So there's your depreciation. Okay, taxable income, that's what you pay taxes on each year, and the total of the year of the sale. Your tax benefit, hang on a second, let me scroll back down here. So principal reduction, you reduced your principal balance by these figures here, and there's your net cash flow on an annual basis. That looks pretty good. Okay, I'm going to go through these next 2 here kind of quickly because I want to get the fastest property. All right, your return on investment tables. Here we go. Initial investment was 72 grand. That stays fixed across the board. Unless you had some other capital improvements like new roof, then you would add that in here the year that you took the hit. Okay, a yearly price appreciation, remember 4% per year. Appreciation net of taxes, you deduct your taxes from depreciation, that's that. Your net cash flow, there's your net cash flow per year. And your net worth increased. You increase your net worth by the appreciation in the property, your equity in the property. And your return on investment, if you add all that up, is there, right? See, not a bad deal. I told you this was going to be a good deal. Look at that, 32%, 37, 39, 42, 44. All right, last table gives you your finance balances. In other words, when you have a loan, that's what this is going to talk about. So there's the loan balance. Initially 288, it goes down per year, every year you pay on it. Your interest is going to drop over the amortization period. Your principal reduction is going to increase over the amortization period. And there's your monthly mortgage payments. Okay, they stay fixed. In any case, that's the end result here. The bottom line, guys, is this looks like a pretty good deal. You know, so Dan, if you're watching, I hope you're on, because man, I'd pursue this thing. All right. So in any case, that's Dan's. What I want to do now is this. Let me go back to here, bring the brand new fresh blank one up here. Okay. Then go back to the Excel spreadsheet. Go up to the top here and bring up Fassel's property, which is right here. So real quick, let me do a quick check on questions here, guys. I know I just gave you an awful lot there pretty quickly too. So let's see, let me go back up here. Let's see, Fassel. Oh, Fassel's asking, how did I come up with 20 years? It's just based on my experience. 20 years ends up being the optimum term for borrowing funds for real estate investment. But let me go back, because I think we got a lot of questions here. We got a lot of questions. Okay, this is going to take a little bit of time. Let's see, this is Fassel. Okay, what is normal vacancy since we are all-time low at 2%? So historically, Fassel, people have plugged in 5% across the board. I think that's a little high. You know, mine historically has been around like 3%, something like that. Vacancy, but I've actually had years where my vacancy was, or let's say occupancy was greater than 100%. The reason is you know, people would pay late fees and things like that. And so if I calculated my income over the period, over what my lease terms were, I actually made more in some of those years. And some years, of course, I made less because I had vacancies. But in any case, historically, people plug in 5%. Mine's always been about 3%. Okay, what is property management fee in percentage roughly? This is for Fassel. This percentage taken from gross. Yeah, guys, management fee is taken from gross receipts. Okay, management fees taken from contract rent. So I charge when I have my own property management company, I charge based on actual gross receipts. Some property management companies charge it based on contract rent, whether the rent is collected or not. I think that's baloney. If you as a property manager can't even collect the rent, I'm definitely not going to pay you, right? So I make mine based on gross receipts. There's a percentage of gross receipts. Okay. How about vacancy percentage? Is that calculated from gross income? Yes. So yes. So that's basically Fassel. That's let's say perfect scenario. You're rented 100%. That vacancy is calculated based on 100%. Okay, let's see here. Sorry, I may have missed this, but how do you figure the debt service? Well, debt service, Fassel, is just principal plus interest on a mortgage, on a note, right? And you use your term and your interest rate. And you can Google mortgage calculator and get all kinds of Quicken Loans gives you one. Bank of America has one, online version. You just calculate your mortgage payment based on the interest rate and the term. Okay. Can you repeat how to calculate vacancy? So I hope it's based on vacancies. It's not like you calculate it. It's when you plug in a figure when you're doing a pro forma or due diligence, you just base it on historical figures. That's why I was just telling Fassel, historically people plug in 5%. But I know right now it's a across the board about 2%. And you can do it based on what we call rentable months. So let's say you have well, the example was an 8-unit building, 8 units, and each one is rented for 12 months. So 8 times 12 is 96 units, or 96 rentable months. So 2% of that means roughly you got 2 months of emptiness in that building over the year. About, because you figure 96 months is close to 100. 2% of 100 is 2 months, right? So slightly less than 2 months. One or more of those units accounted for almost 2 months of vacancy in that building based on the rentable months. Number of units times 12. Okay, thanks for the question, by the way, you guys. Okay, since vacancy is a killer of profits, why do we sometimes see a large commercial space like a large grocery store empty for a long time? Is there a loss in profit that can be taken advantage of tax-wise? 72,000. I think, Susan, if when you say 72,000, I wonder if you're talking about tax rule 172. But in case, Susan, a big commercial. Oh, by the way, Susan, you had a property we were looking at last week. I wanted you to send me information on that so we could bring it up on one of these webinars and pick it apart. I don't know if you saw the email back on that. I mean, I had whatever information you gave me, but I was looking for like a listing or a pro forma or some type of chart like Fassel and Dan have. If you can do that, Susan, that would help a lot. We can get a lot of insight here on these webinars by doing that. We can do it one-on-one if you want. A great exercise to do with other people. So in any case, back to your question, commercial is far more volatile than residential, guys. In other words, commercial, you have fewer people, fewer clients, fewer tenants that can and will rent commercial properties. Because they're bigger properties and they're more likely to be specialized, you have fewer people, you have longer vacancy periods, because let's say you rent a property to a Sherman Williams Paint or a Tile City, okay, or something kind of unique like an industrial space or an office space or something like that. There are not that many paint companies out there. There's not that many tile floor companies out there. So when one of them moves out, it may take a while for you to find a replacement tenant. Okay. The other thing, Susan, is in commercial, a lot of times us owners, we require the commercial tenant, to customize or modify the space to be suitable for their purposes. So those consumers are looking at these commercial properties, determining how much it's going to take them to customize it to suit their needs. And sometimes it takes them a while. I mean, believe me, people don't want to move, especially in commercial. So the reality is there's a number of factors there, but the primary reason is, Susan, is it's just more volatile. Commercial is more susceptible to the whims of the market, and you'll have longer vacancy periods as that. You'll even have properties sit empty for years sometimes until the right tenant comes along. That's really what it comes down to. Let's see, Fassel, how did you come up to 20 years? That was, remember, Fassel, I explained that 20-year term. 20-year question. Yeah, okay, thanks. Genevieve says, oh, thank you, Genevieve. That's when I sneezed. Thank you, Genevieve. How about that? The Canadians are one that remembered to bless me. I'll let many of you know my wife's Canadian, and Canadians are known for being very polite. So thank you, Genevieve, for doing that. Okay, Susan Bai is asking again, why don't we include the calculation, the buying cost? We always include a little bit, like a small percentage, like in the example, Susan, I put 1%. When a property is sold, most of the cost of selling falls on the shoulders of the seller. The buyer will have some cost. I mean, like if they're getting a loan, they'll have points and things like that to pay to the lender. They might have an inspection fee or an appraisal fee or things like that, but usually on a percentage basis, they're not that great. Now, if I was buying a property, Susan, I knew I needed to make some major capital improvements, I would definitely include those in the buying cost. That would be added onto my cost basis, okay? So for the example, I was assuming, remember I said I was assuming it was turnkey. You buy it, you move right in, and you start renting it right away. Or it's already rented and I'm just taking over. That's what we meant by turnkey. Thank you, by the way, for the question. Okay, we can do mine next time since we do not have much time. I do not mind. That's Fassel. Thanks, Fassel. Susan, 72,000 was an answer to a calculation. I'm trying to remember what the 72,000 was. I have to look back, and we just erased the online version for Dan. So maybe it was in the Excel spreadsheet. Oh, no, Susan, I'm sorry. The 72,000, that's the down payment, 20%. I'm sorry, yeah. 20% was original down payment on the property. Okay, 20% of 360,000, 72,000. Okay, oftentimes larger commercial buildings, even though vacant, many commercial tenants are still paying the investor rent. This is especially true with many national tenants. Yeah, they have guys, let's see, was that Bill that put that in there? Hey, Bill, hey, doing? Long time no see, buddy. Yeah, Bill's right, guys. A lot of commercial tenants, they'll sign like 99-year leases. You know, let's see, what would you guys recognize out on the east there? Wawa, or now Sheetz is going all over the place. Circle K, if you're out west, will sign 99-year leases, 99-year leases. And believe it or not, if they leave, they've got there's a buyout. They got to actually pay that off. You know, some kind of they negotiate or whatever if the seller wants to, but they're committed to that, right? By the way, they're usually triple net leases, and those are commodities that can be bought and sold. One of my favorite colleagues in my mastermind group, GoBundance, his name's Ken Wimberly. We had him on speaking here back in the May of 2017, by the way. He specializes in triple net leases as a commercial guy. Makes a ton of money doing it. That's like what he does. That's what he's known for all over the country. So thanks, Bill, for bringing that up. Okay, Daryl Murphy, how can I get that analysis form? Hey, Daryl, that's on. So go to the My Invested Services. Remember, so you go to silver level, My Invested Services. Okay, let's go back here and go into analysis forms and calculators right there. It's highlighted right now. Click on it and you will get these. So the property, this one here is the Excel spreadsheet, Daryl. That's one we were showing here, Excel spreadsheet. Okay. Oops, there we go. And the other one is the rental property management, rental property calculator, which is the reporter, basically. Rental property reporter, and that is this one. So they're both available to you on the server level membership area. Let's see, next question. Susan, is the closing cost the same as buying cost? Yes, yeah. Closing cost is the same as buying cost. Now, cost basis though, Susan, like closing costs are expenses you take in you get a tax break on the year you took the expense. Down payments, capital improvements like a new roof, for example, those are considered capital improvements, and those get added on to the cost basis. You don't take that write-off that year. You amortize the write-off of a new roof, for example, over a period of years, essentially 27 and a half years. There is a tax rule called Tax Rule 172 that's meant for businesses in general, which means in some cases you can take a capital improvement, the cost of a capital improvement, and actually write it off in the year as if it was an expense. Talk to your tax accountant about that. I'm not a tax accountant, but I've used it myself a lot. I've had some tax accountants say that you can't do that in real estate, and some say that you can. I believe that you can because I've done it, and I tell you the way to do it is if the property is owned in a corporate name, then that corporation is in effect a business. The underlying business just happens to be real estate. There you go. Okay, so let's see. Okay, Gift. Hi, Gift. How are you doing? Do we have time for one quick question? Yes. So whatever your question is, Gift, let me have it. Let's see. Oh, Susan. Oh, Susan. I'm sorry. I didn't see your latter statement or to not address that. Apologize. Okay, the connection is a little fuzzy. I'm not sure. Sometimes it's the Wi-Fi in the hotels, Joel. I'm not sure. Well, it could be your computer. I'm getting 100% here, so it looks like we're okay on this sending end. Everybody else seems like they're okay. Hey, Fasto, we're going to do your property. We'll do your property next week, Fasto. That's going to be next Wednesday night. Yes, next Wednesday night. So I apologize we didn't get to it, but whenever we do this, guys, this always generates lots of good questions because these are two really important tools, and this keeps you in the mindset of looking at properties and analyzing them. Okay, so this is Gift's question. Cost of house 285, monthly rent 1950, tax appraisal 284. Let me go back here. So 285 is the house, monthly rent 1950, tax appraisal says 284. Okay, and new appliances, new roof, Giant Foods, Ahold, Wegmans, Dollar General, all sign leases that have non-competes for their properties. Oh, that's Bill's chiming in on the commercial leases. Properties in the event they vacate, investor must then find a non-competing. Yes, that's correct. So guys, we'll do another session just on commercial. We'll do several on commercial, by the way, because we actually did that a few months back. I think we did a couple of sessions on commercial. A lot of times like in a strip mall, an anchor tenant will require the owner in the lease, it's written in there, that they can't bring in a competing business into that complex. They can only bring in complementary businesses. And also they will put in there that if the tenant leaves early and they got to still pay the remainder of the lease, that the owner, because of that, they can't bring in a competitor in that same space, even though that tenant vacated the space. The reason is chances are the tenant just moved down the road. That's why. Okay. So good point, Bill. So let me get back to the Gift. Let's see. Greenwood Lake, New York has varied flood zones. Is this area worth the risk? How significant would flood insurance affect the profit? So Gift, I'm trying to get back to your question. There should be more information there. And then that was Stephen. Hey, Stephen, I'll get back to your question too. Okay, so Gift, what are your thoughts on these numbers? Oh, so 285, Gift, there's one thing that really stuck out in my mind that I didn't like about the property you brought there is the gross monthly rent is less than 1% of the purchase price of the property. So in other words, if I'm going to pay $285,000 for a property, then I want $2,850 coming in on a monthly basis on rent, 1%. That's my rule. It's the Gary Wilson rule. It served me well. If you do the calculations on that property, down payment 20%, mortgage of 20 years at 5%, and your gross rents are much greater than that outlay for the monthly mortgage payment, and enough for you to absorb maintenance and repairs and taxes and insurance and all that, and you still have the hefty cash flow left, then certainly pursue it. But definitely use the calculator to determine that, and that's why we did the exercise tonight. But again, my personal rule is the 1% rule. I call it the Gary Wilson 1% rule. I know there's parts of the world, like I can tell you, Vancouver, Toronto's prices have dropped, by the way. But San Francisco, New York City, I mean, you might have to break the 1% rule. But you're in Washington, D.C. and Northern Virginia area, Gift, and I would think you can find areas around it, because remember, I used to live there where you can meet the 1% rule. Okay. All right. So here's Stephen's question. Flood zones. Right. Greenwood Lake, New York has varied flood zones. Is this area worth risk? How significant would flood insurance affect the profit? So, Stephen, flood insurance is mandated by the federal government from FEMA, and it's a fixed cost. It doesn't matter where you get the insurance. Everybody pays the same. You could go to 5 different insurance carriers. It doesn't matter. They're providing federal government subsidized insurance, and it's going to be the same wherever you go. So it's fixed. There's different floodplains, 100-year plains and 500-year plains. If you're in a 100-year flood plain zone, right, and you determine it, they'll tell you if you're in zone A, B, C, or 1, 2, 3. They changed the designation several years ago. If you're in zone 1, which is a 100-year floodplain, you're going to have more flood insurance premium to pay. I mean, if it's $1 million property, then you could be paying a few $1,000s a year, obviously. So you do have to account for that, Stephen. It doesn't mean that it's not worth the investment. It just means you have to account for the expense when you're doing a pro forma on that property, okay? If I haven't said that, I've actually had properties flooded. I mean, it was disastrous. Thank goodness I had flood insurance. And I will tell you the reason I say that is because I ended up making money on the properties, not illegally. It's just the adjusters were coming in. I mean, they had so many properties to go through. They would look at a property and just make a general assessment and say, we're going to send you a check for X amount of dollars, right? Now, what I did is I didn't make money on the insurance, by that's not what I meant. What I meant was I improved the properties to be up to, basically up to code, clean, reliable, and now they're all remodeled. I mean, they were remodeled. I mean, brand new kitchens and bathrooms and carpeting. It all had to be redone. So now these properties are worth more money, and I was able to rent them for more and eventually sell them for more money than I would have otherwise. So bear in mind, for every adversity, there's a golden opportunity. But that's why we have things like flood insurance. Okay, I ended up profiting basically because of the floods. It took a while to realize that profit, but believe me, I profited. Okay, so that's why I say don't throw out the baby with the bathwater. Definitely do the analysis, Stephen. And if you have questions, just bring up the property to my attention, and we'll look at it sideways, backwards, every which way. Okay. Okay, Gift. What are your thoughts on these? That we went over that. Other house is selling for $320. I mean, so Gift, if you're going to keep that house to rent it out, though, you're looking at it for cash flow purposes, not necessarily capital gains. However, you can look at it both ways. Remember, in any rental property, you've got cash flow, net operating income. You've got appreciation that goes up in value. You got depreciation, which is the write-off, phantom write-off for owning the property. You've got equity pay down. Your mortgage gets paid off over time, and those are the four major ways. So if you're leaning more towards cash flow, you don't really care so much about what other things sell in the area. If you're leaning more towards appreciation, you do care more about what other properties are selling for in the area. Sometimes it's a combination of both. So you have to figure out what is your motivation for the property. Is it cash flow or appreciation or some combination? I would still want to, if I'm looking at it from a cash flow perspective, I would want a better deal than that. If I'm looking at it for appreciation, chances are it's going to keep going up in value, right? And you could maybe you get a small cash flow now, assuming that the property is going up at 10% per year, for example. And if that's the case, hold on to it for 5 years, and it'd probably be a good deal. So remember, there's always multiple ways to look at these properties, guys, which is why I love these calculators, because one of them is fixed in time, the Excel spreadsheet. The other one is the 5-year projection. So you can see, while something might not be the best deal right now, in 5 years, it could be a pretty spectacular deal. Okay, that's why we use the calculators. Okay, let's see. This is Susan. Okay, Bergen County, New Jersey can't do 1% of purchase price either. Yeah, so whatever it is, Susan, just use that, for your area, whatever's commensurate for the area. So that's a variable field. You plug in 1%, 2%, whatever. The good news, you get to plug in the value, what you think that should be, okay? Let's see, does the age of the property affect the value of a home if the let's see, got cut off there, the renovation. Yeah, so Susan, the older a property is, generally speaking, the more costly renovations are going to be. And also over time, if it's one you're keeping for rentals, you should assume a higher maintenance and repair ratio. In other words, buildings built 1978 and later would have a lower, I would assign a lower percentage for maintenance and repairs, percentage of income to be for maintenance and repair expenses. In an older building, I would raise that percentage, because older buildings just, quite frankly, have more stuff to go wrong with them because they're older. So the answer is absolutely, age of the building will definitely affect your cost of repairs over time, and essentially your cash flow on the property. Okay, let's see, Gift, thank you. Glenn was trying to buy, but I am not agree with. Oh, so Gift, I hope I'm not getting in the middle there. But gift, that's why we do these calculators, so you can look at things objectively. I'm sorry, objectively, yes. And you can remember the numbers don't lie. Use the calculators and let the calculators help drive your decision-making process. So I'm kind of glad to hear you're saying that. And please tell Glenn I said hello, by the way. Okay. And by the way, I think you guys were looking up in like Frederick, Maryland for a while. Gift, that might be, you might have to travel some distance. And by the way, Northern Virginia, go out to Manassas, go down to Fredericksburg. Don't be afraid to drive that extra hour out of your way, because it'll be worth it. Okay. Let's see. Yeah, so Gift, the calculator is on My Investment Services in the members area. Go to login server level and go down to the resource page. Okay. Go down to the resource page, excuse me. And here it is right there. So this is your resource page in silver level, My Investment Services. Go down to the bottom of this blue panel, click on calculators and forms, and you get this screen right here. And right here is the calculator right there, the Excel spreadsheet, and right here is the online real-time version. Okay, let's see, guys. Joel, could you please go over the 1% rule again? The sound was muffled. So Joel, what I'm saying is, anytime I buy a rental, at a minimum, I want my monthly gross rents to be equal to or greater than 1% of the purchase price. So if I'm buying a $300,000 building, then every month I want that property bringing in $3,000 in gross rents. That's that 1% rule. Okay, let's see. Well, you guys are all full of questions tonight. We're going way past 8 o'clock, but that's okay. I'm okay if you're okay. Okay, is there an age of the property that makes it more of a knockdown? Yes, Susan, I wouldn't say that. I mean, there's some pretty spectacular properties that are hundreds of years old, and some of them get what's called historical, they're basically National Historical designations, okay? National Historical Society designations. I've actually owned one of those, and it was 100 and something years old, but it was a solid stone building. Man, that thing was a real charmer. So I wouldn't say that, Susan, carte blanche. You have to look at the area and see if it's commensurate with the area. And every house there is 100 years old, and people, it's a desirable neighborhood. You want to probably look there to do a flip, for example. But in a rental area, I would probably lean away from the 100-year-old buildings in a rental area and lean more towards the newer ones. Okay. Let's see. You're welcome, Gift. You're welcome, Joel. Let's see. Alfred. Hey, Gary. When will we be able to watch this again? Thanks. Thanks. Hey, thanks, Al. I hope you guys are doing well, Al, by the way. Hope what you and I exchanged last week in emails was helpful. So, Al, you'll get the recording of this the very next day, and you can rewatch it over and over again as long as you want. And you can stop it and pause it and rewind and fast forward, which is pretty neat too. Okay, Susan, you're welcome. Thank you very much. Alfred, you're welcome. Hey, guys, I think we just hit the end of the questions. How about that? And it's only 10 after 8. Okay, guys, good session tonight. I know it went a little bit long, but you guys have great questions. I love doing these analysis on these properties because it really does help you come up with some pretty good information and even some answers. I will see you next week. That is going to be October 3rd, same time, 7 p.m. Eastern. And Genevieve, let me know if you ever come down to Toronto. Let me know, because I go up there, with some frequency. In fact, I'll tell you, Genevieve, I'm going to be living in Toronto from American Thanksgiving all the way to Christmas. The reason is I'm going through a special coaching program there, and I want to be in town by the coach. I'm renting a place for a month up there. No classes in the month of December. I mean, we'll do webinars every week like we do now, but I'm not going to be teaching the daily classes in December. I'm taking the entire month. Well, I'm not taking off. I'm going to be working on the business. The reason is we got some really neat stuff we're cranking out for you guys, and we need to take the time off the road to implement them. We've already been doing development, but there's some really neat stuff coming on the road, guys. So we're having a really nice Christmas gift for you guys this year. Okay, so take care of yourselves. Thanks again for the opportunity for me to teach and help you and help you grow your business, guys. It's a wonderful opportunity for me to do this. It's a lifelong dream come true. I wish I knew it when I did it in my 20s. But in any case, God bless you and your families, and we will see you next week. Take care, guys. Bye-bye.